Is the Federal Reserve already too late in cutting rates? That's certainly what a lot of economists and analysts seem to think. The Federal Reserve met on Wednesday to discuss the outlook for monetary policy and decided to keep rates unchanged at the 5.25 to 5.5% level. However, a lot of people believe that the Federal Reserve may be too late in beginning its cutting cycle, and that therefore they could spur a recession by being overly tight. Now bear in mind that based on the last Fed dot plot, the Federal Reserve has already projected about 3 rate cuts for 2024. However, we got no rate cut this week, and the outlook is that we won't necessarily get a rate cut in March. Jerome Powell said in his speech that, having come so far so quickly, the Fed is moving forward carefully, as the risk of under and over tightening are becoming more balanced. Jerome Powell also talked about the risk that inflation could return, and that makes sense when you actually look at some of the most recent data. For example, we got really strong quarter-on-quarter GDP data, and we also know that employment has been very resilient. With such a strong economy, it makes sense that the Fed may not want to loosen too soon. However, could there also be a risk that by not cutting sooner, the Fed is already over-tightening us and forcing the economy into recession in the future? That's certainly a strong possibility, and we have plenty of evidence to suggest this. To anyone that has been following the Federal Reserve and the macro picture over the last few years, you're probably aware that the Federal Reserve has already been pretty late in acting before. A clear example of this is the recent inflationary cycle that we got following the 2020 COVID lockdowns. For a long time, the Federal Reserve said that inflation was transitory. However, this did not turn out to be true. Of course, the Federal Reserve did eventually start to hike rates, but by then it was too late and inflation reached levels we hadn't seen pretty much since the 70s. Now we have to bear in mind that monetary policy acts with a lag. That means that the economy right now is still digesting the Fed rate hikes that happened last year. With that said, we might actually expect that the economy could begin to slow down in the coming months. A lot of economists don't see a risk of inflation returning, but rather a risk of inflation coming too low and even entering deflationary territory. Now, there's good arguments to support this too. If we look at Europe, we can already see some pretty strong deflationary trends. Of course, Europe has struggled with growth a lot more than the US, so this is actually a little bit of a different picture. Now, a lot of other economists are pointing at this chart to suggest that deflation could happen sooner. What we can see here is M2 growth and inflation over the past 50 years. As we can see, M2, which is a measure of broad money, that means bank deposits and money that is utilized in the system, has been coming down in the last year very sharply. This has generally been linked quite strongly with inflation and could suggest that inflation should continue to come down sharply and maybe even fall below the Fed target. So as we can see, based on the data from the CME, there is about a 60% chance that the Federal Reserve will keep rates unchanged in the next meeting in March. Meanwhile, the market is pricing in about a 60% chance that the Fed will indeed begin to cut in May. Now, whether this is too soon or too late will really depend on the kind of outlook we get for US employment and recent productivity numbers, and we'll definitely speak a little bit more about this later. But first, I'd like to talk about what we can expect after the first rate cut. Now go ahead and look at this chart. As we can see in this chart, we have all the Fed cuts listed as of 1984. We can also see that they are categorized in terms of type of cut. This is much easier done in hindsight, but it still gives us a good idea of what we can expect in terms of market performance. As we can see, the cuts of 1984 and 1989, 1995 and 2019 were considered a normalization, and all led to a very strong market recovery. Although it's interesting to note that over the following month, markets had a negative performance except for 1995. The worst one-year performance happened after cuts which preceded recessions, such as 2001 and 2007. The best one-year performance, funnily enough, happened after the panic cut of 2020 in response to the COVID pandemic. But note that the other panic cuts of 1987 and 1998 delivered a very strong one-year performance, 30.9% and 20.9% respectively. Of course, based on current data, we would think that we are right now in that normalization camp. In other words, everyone seems to be expecting a soft landing, and based on that, we could definitely expect markets to perform well in the coming year. But bear this in mind, back in 2007, when the Fed issued their first rate cut, it was only discovered a few months later and decided retroactively that the economy was already in a recession back then. To this extent, is it possible that we are already in a recession? Again, it seems unlikely looking at the most recent GDP and employment numbers, which have been incredibly strong. However, by some measures, such as this one, there's a 75% chance that we could enter a recession in the next 12 months. Again, this means that we would enter a recession And that means that we could retroactively already say that we were in a recession by the time the Fed issued its first rate cut. Now bear in mind that this recession probability tracker is based on Jonathan Wright's yield curve-based recession forecasting model, which factors in the one-quarter average spread between 10-year and 3-month constant maturity US Treasuries. In other words, it tracks the inverted yield curve, which has of course historically been a very good measure of recessions. Typically, when the yield curve uninverts is when we begin to see US recessions, as we can see in the grey highlighted areas in this chart. But here's the thing, could this time be different? Never before have we had such a high level of fiscal spending with such low unemployment. In fact, we've seen a fundamental shift in fiscal budgeting since the COVID pandemic. As we can see, we've had record amount of spending, and again, only in times of war or really high unemployment recession have we witnessed such high levels of spending. We are right now in a moment which is in fact an anomaly and therefore different. As we can see, we have a huge level of fiscal spending, in other words fiscal stimulus, when the economy is actually very strong. Big reason behind this is of course the fact that we are in an election year. Now typically governments tend to spend more during those election years to try to push up GDP numbers and facilitate re-election. In fact, if we look at historical performance of markets in election years, we can actually see above average returns in those election years. So with that said, I do believe that this time could be a bit different. Even though I do agree that the Federal Reserve could be a little bit late in cutting rates, I don't think that necessarily is going to matter so much given the huge fiscal impulse that we are seeing this year. With that said, my expectation is that in 2024, we will see markets go much higher. Of course, that doesn't change the fact that I'm still expecting a recession to hit the economy possibly in late 2024 or 2025. Of course, even if we technically begin to enter recession, it doesn't mean that the market necessarily starts to go down. However, I do expect markets to come down potentially in 2025 or 2026. Of course, in order to know how this will evolve, we'll have to keep a close eye on different indicators such as employment numbers, GDP, and productivity levels. But for the time being, liquidity dynamics are supporting a strong economy and higher stock market prices. Once again, if you like this kind of content, go ahead and check me out on Substack. I do a lot more there: macro, technical analysis, in-depth stock analysis, and a lot more. So, thanks for watching, and I'll see you in the next one.